Well, good morning and welcome to your Financial Empower Hour. This is Jason Cryderman with Great Lakes Investment Advisors. Happy Sunday. Here we are, Tony Shore. It's the middle of May. Can you believe it? I have no idea where the time goes. My wife and I were talking over the weekend. We're preparing for Lexi's graduation party, and it seems just a year or two ago she was in sixth grade, right, and graduating from junior high, and
right,
from elementary to junior high, and now she's graduating from high school. But the year has flown by. So, but as we get jumping into our show today, I have a very special guest again on our show. Tony, you seem to amaze me. Every time I say, hey, we need a guest on the show, I give you some ideas and topics I want to talk about. This week, I want to talk about basically a stock market and economy update. Here we are past the first quarter of the year. We're deep into the second quarter. The market was up. The market was down. It's all over the place, right? There's a lot going on. So I said, hey, Tony, I want to talk about a market and economy update. See who you can reach out to at Gradient Investments and get us today. And as my viewers are seeing on my YouTube channel, and as my listeners will hear the charming voice of in just a minute, we were very, very lucky to get one of the top portfolio managers at Gradient Investments, Tyler Ellegard. So Tyler, welcome to the show, and thanks for joining us, buddy. Glad to have you today.
Thanks for having me back. It's always a pleasure.
Always a pleasure having you, man. Always a pleasure. Whenever Tony or I can reach out and get you guys on the air, especially
sure.
As often as we do, it's so cool. It's so powerful. And I know a lot of my viewers and listeners really appreciate it because I don't know if I've told you, Tyler, but Tony and I talk about it all the time. The week after we have a guest like yourself or somebody else from Gradient Investments on the show, our phone rings off the hook. And we got a lot of emails coming in about, hey, when Tyler talked about that, hey, when Tyler said this, hey, what did Tyler mean? Hey, can we get a hold of Tyler? So it's awesome. We know that this week after this show airs, listeners, viewers, please, if you have questions or concerns, don't be shy. It's normal. Our phones will ring off the hook, and that's exciting. So, Tyler, thanks again. But before we jump right into the show today, Tony, Tyler, what's going on with you guys over in Minneapolis, Minnesota? What have you been up to?
Well, first of all, let's address when you said, hey, get me somebody for the show. I want a market update. Of course, my first call is always going to be Jim Cramer at CNBC. And Jim said no. And then the second call.
He turned you down again?
Yeah, again. And the second call is always Mike Binger. And at Gradient Investments, he turned me down, was unavailable. I think he was, I don't know what he's doing.
Who knows?
I should stop you here, Tony, before I become the sixth string.
No, I'm kidding.
How many more people did you call, Tony?
I only asked Tyler. I was joking. I wasn't going to go any further. Don't worry, Tyler. It's a joke. Tyler's top of the list. It's either going to be Tyler or Keith Gangle. Those are my top two go-tos. And I think we're fortunate to have Tyler on today, but I've been doing good. I've had a great week. Last weekend was Mother's Day. Spent it with my mom. My wife was excited. All the kids came over. She had a to-do list, knocked that off. So all is good in the Shore household right now. Tyler, how about you? What have you been up to? You mentioned you're doing a little construction work at your place, right?
Yeah, it's been a process, certainly learning. My background is not in construction, but I do have a background in woodworking, so at least I have a general sense of building.
Sure.
But YouTube University has been great.
YouTube is great.
Learning how to finish my unfinished basement. So we're finally getting sheetrock and drywall this week, and so hopefully after that it's smooth sailing. So that's been on my top of mind and top of to-do list for the last, call it, 2 months or so.
Wow.
Yeah, I think that's the last time I had you on the show. It was probably about 3-4 weeks ago or so. And you were getting into the project at that time. And you and I,
Yeah.
Tyler, talked. We swapped a couple good stories on the air, I think, but especially off the air. Good and bad stories, because it was actually during COVID 2020 when my wife and I decided to finish our unfinished basement of our home. And so we had talked about the funds and the not so fun stuff when you decide to, hey, I'm going to try to do most of this I I can by myself, right? And YouTube was a savior for us too. Like, I don't know what the heck I'm doing. Well, YouTube it, right? YouTube it, and you can learn almost anything out there. And for the most part, I was able to pull a lot of that stuff off on my own, just like you said you were, Tyler. But you and I have one really, really big thing in common when it comes to construction, and that was no drywall. Like you said, you hired that out. I did the same thing. I said, first, I don't want to hang the stuff, and second of all, I definitely don't want to sand it and mud it, and that's so we hired that out as well. So you and I are definitely the same.
I don't need my walls having humps on them, you know.
Well, mine would definitely not be smooth, and you know, you put in so many holes. I can't cover all those holes in the walls, and just not something I want to do.
Yeah.
So how much longer before the project's done, you think? You mentioned drywall this week?
Yeah, this week, and then we'll measure for cabinets. We're going to put a little cabinet storage bar thing down there, and then once those are in, then we'll put carpet. So we're really only 2 items away after this.
Isn't it so cool when you're sitting there looking and now and thinking over the last 3 to 6 weeks what it started like and where it's at now? I remember when we first got even the walls framed in, you could vision, hey, there's a hallway, there's a doorway, there's a room, right? And then especially when the drywall gets up, wait till you go home each day this week and see when the rooms in the hallway actually gets drywalled in and it starts to take the almost the final product. I mean, it's so fulfilling and so nice to know that we're almost at the end of the tunnel.
Yes.
You'll be able to enjoy it. You and the family will be able to enjoy it pretty soon. Yep.
Yeah.
Are you wiring it for sound? Are you having wires put in? What are you doing down there?
Well, so we have 2 little kids, right? So a 3-year-old and a 1.5-year-old. And so we're literally, instead of putting a bathroom, bedroom, living room, we're literally keeping it just one big open room.
Oh yeah.
For them to just do whatever they want down there. They can wreck the walls. They can do anything. So
you better be good at patching drywall then.
That I wouldn't say I'm a pro at that, but I'm okay. So I'll be okay with that. We'll be good as long as they're having fun down there. Who cares?
That's cool. Very cool, man. Yeah, very cool.
That's awesome. Well, did you do anything for Mother's Day, Tyler?
I did. Well, I mean, my wife, we just had a at-home day, and then we went out and did a little shopping and had some dinner with the boys after at a nice little restaurant. So
nice.
That was really about it. My parents were out of town, so nothing for them. But
okay.
Yeah, I at least called and texted. So
that's good.
Oh yeah, you got to do that. And Jason, I assume you celebrated Mother's Day as well.
We did, yeah. We actually celebrated Mother's Day twice. We celebrated with Amy's mom on Saturday. Her brother had a little cookout over at his house, so a lot of her family got together over there on Saturday for her mom and for the moms in that side of the family. And then on Sunday, on Mother's Day, we went into Saginaw and took my mom out to lunch and spent some time at her house and brought her a nice hanging plant and spent some just, and at this point in time, really, it's a matter of, I really kind of reflected on the ride home and at the age that our parents are all getting. And as you especially know, Tony, with your mom and dad, it's the precious moments we get to spend with family, right? And as Tyler, you mentioned with the kids, I mean, that is such an awesome, precious age at 1 and 3. I remember when my kids were 1 and 3 and it's like, no way. Now Lexi's graduating. She's going to be turning 18 years old this year. She's graduating, going off to college. So Tyler, don't blink, man. Take in all those precious moments. And when you say you had a calm afternoon with the fam, that's awesome. Take in all those minutes you can because take it from Tony and I. Tony's kids are already grown and out of the house. My kids are almost to that point of getting out of the house, and yours just got in the house, Tyler. So it's a great mix. But yeah, so it was awesome just to spend time with the family, you guys. And so that was really what my Mother's Day consisted of, is just kicking back, the little laughs, little tears here and there, but having an awesome weekend overall. Yep. It really was
that's
great.
Nice. That's great. Well, I know there's a lot going on with the market. We've had some big news lately.
What's going on with the markets?
Yeah, so we're gonna get into that, and we've got the man with the plan on the show today, Tyler, who is a portfolio manager for Gradient Investments. But before we get into the markets, because we're going to want to really dig into that, I want to take a quick break for our listeners and let them know how they can get a hold of you, Jason, if they have any questions or questions for Tyler, or if they want to get a copy of your book, we're going to be giving away 10 books to the first 10 people who call and request a copy on your office line there. And if they say they heard about it on the show, they'll get a copy, no charge, no postage. We'll send you one. So, Jason, let's do that. 989-835-7203 is the number. That number again. Listeners, pick up the phone, give Jason and his team a call. 989-835-7203. And, of course, the website is GreatLakesInvestmentAdvisors.com. All right. You are listening to Your Financial Empower Hour. I am your co-host, Tony Shore. I'm here with our host. The man with the plan is Jason Cryderman. And we're here with a very special guest today, Tyler Ellegard. So, Jason, what's your first question for Tyler?
Well, the last time Tyler was on the show, we talked a lot about what the heck's going on in the market and the economy. And I think if I jog my memory right, it was back to when the market was starting a pretty severe decline in 2025 here. After the election of November of 24, then we get into 25, market was doing pretty darn good. And then there was a lot of turmoil. Then there was a lot of just a lot of changeover, right? A lot of change. And then they threw out the T word. Tariffs. And so we talked a lot on that show, Tyler, about what is a tariff and what are the goods and the bads, what are the pros and cons, and what is the short-term game and more of the long-term game with this tariff play that we were seeing at that point in time. And it was very new. We were very, very early in the game. And now we've seen a lot of things have played out, some good, some not so good. And here we are now after quite a severe decline in the markets. We're on quite a nice upside or up movement of the markets over the last maybe 1, 2, 3 weeks here. So really what I want to talk about today, Tyler and Tony, is what have we went through? What has happened since, let's call it January 1st, when the T word was thrown out there in mid-March maybe, and where are we now? And what do we think has been happening recently, and where do we see the markets and the economies potentially moving going forward? I know that's a lot, and so for our listeners and viewers today, if you're listening on the radio and you're driving, pull over, take 20 minutes, take a half, pull over and listen to what Tyler has to say today. If you don't have a chance, the next chance you get to look us up on YouTube or look back on my website or listen to us on one of the podcasts or something, please listen to this show, because Tyler and Tony and myself are really going to bring us through the last 3 to 5 months. What the heck's been going on, the good, the bad, the ugly, and indifferent, and where are we economically, and where might we be moving going forward into the rest of 2025. So on that note, Tyler, I'm going to turn it over to you, my man. Start where you want. And Tony and I are going to jump in here and there just to kind of make sure we understand what you're talking about and kind of reiterate some things for my listeners and viewers today.
Perfect. Yeah. So I think you laid that out great, right? The market we started to see the market falter a little bit when the initial tariffs were announced. And those are referred to as the fentanyl tariffs that were put on Mexico, Canada, and China, our 3 largest trade partners. And then we got more tariffs on autos, auto parts, steel, aluminum. And then eventually we got to April 2nd, which was the coined Liberation Day. Those were called the reciprocal tariffs, the tariffs that Trump and his administration were putting on other countries that had the tariffs supposedly on the U.S. Now, the calculation for those tariffs is pretty simple. We don't need to get into that, but it wasn't the fact that these countries had 42, 49, 47% tariffs on us. It was just the trade deficit that we have with them. Mm-hmm. So that's really what sparked the big sell-off in April, right? We had on April 3rd, when the market opened up, market dropped about 5%. Next day after that, another 5%. And then that Monday, the market fell 3%. Then we wake up on Tuesday, the market isn't doing a whole lot as we continue to digest the tariff news. And then Trump announces a 90-day extension or pause on the reciprocal tariffs with a 10% base rate tariff on all trading partners except for China. So that's really what sparked the market Tuesday, and the market finished up 9.5% in one day. right? Because it gave the relief from companies from having to pay 47% extra from Vietnam. A big thing that we get from Vietnam is clothing, shoes, Nike, right? Things that we are wearing on a daily basis. And so if you wake up overnight and all of a sudden your $100 item is now 147, that's a significant impact to consumers. And that's why we saw the market sell off those days. And also why we saw the market rally on that Tuesday when the pause was announced. So fast forward, there's negotiations happening between the Trump administration and a lot of other countries. Which ones is a little bit in the dark, but we have heard now that there is a deal with the UK. We heard Trump meet with new Prime Minister of Canada, Carney, and they were discussing potentially readjusting the USMCA. And then last weekend, we had the US meeting with China in Switzerland, and there was agreements. So this may change as when this airs, but as the Scott Bessent was coming out of that meeting, there wasn't necessarily a deal, but he hinted at certain agreements being made. So there's a lot of different numbers being thrown around at the time of recording this on what the tariffs on China are and what the actual agreement is. I've heard 10% will be on China, and China will have 10% on U.S. goods. So a significant de-escalation from what we had as 145%. And I don't necessarily know what China had on the U.S., but I believe it was close to 145% as well on all U.S. goods going to China, which has a big impact on our trade relationship and potentially detrimental to our relationship with China and a lot of other countries for that matter. So what I think the market is taking from this, because we are seeing a significant performance on the day of the Monday following the negotiations over the weekend with China, because it's now becoming more of the art of the deal for Trump rather than these tariffs being in place for an extended period of time. And that's what the market likes. So the market's reacting in a way that tells us that we were ready for a deal to happen between China. We're also ready or we have a framework laid out for other countries to negotiate to make sure that those 47, 24, 50% tariffs don't go back into place. And when you think about it, a 10% tariff is a lot easier for a company and consumers to handle than a 50% tariff. Reason being is every company who has major suppliers overseas, they're going to go to them and say, out of this 10%, what if you take 4 of the 10? I'll take 4 of the 10 and we'll pass 2 to 3 on to the consumer. The consumers can handle the 2 to 3%. What the consumers can't handle is the 50, because we heard a lot of companies come out and say that they're going to fully pass through the tariffs if they were going to be at the 24%, 50%, 145% in the case for China. Whereas now it's not, because there's no way you can negotiate with your suppliers when you're talking about 145%.
No.
But with 10%, you can negotiate that with your suppliers. And case in point, we saw Walmart do that back in 2018 when Trump initially announced his first round of tariffs on China. And what Walmart did was they went to their suppliers, because Walmart is the largest importer of goods from China. They went to those suppliers and said, you guys are going to eat all of the costs. And so we didn't see any price increases from the products that Walmart was importing because the suppliers were taking on all of those additional costs. Now, I don't think that can happen again. I do think Walmart and U.S. consumers are going to have to take on some of those price pressures. But like I said, the 2 to 3% I think is much more manageable. Even if a company did pass the 10% through, yes, it's absolutely painful for the consumer, but 10%, I would take that any day over a 50%, right? Because there was a article going around that had products from Temu, which is a Chinese retailer, online retailer, and they had what the tariff impact was on the prices split out from the actual cost. And so for a $19.50 power cord, it was $27 in tariff charges. Right? So
that's crazy.
Basically bringing it to a $47 product that used to be $20.
Crazy.
That's a significant impact because now you're not going to be buying as much stuff.
Right.
So it is huge that this deal was made. And I think it's like, down to 10%, as you said. That's a big difference. And I think we know there's going to be tariffs on China. I think the goal long term is to try to rely less on China for things. And that was part of the goal. But I don't think economically we could have withstood the 140% or, whatever it was at there for a while.
Yeah. And, I'll caveat it with this is we're not out of the woods yet, right? If these negotiations begin to break down, Trump is going right back, right? He's quick to react, especially when it comes to China. He's quick to react and raise these tariffs back up. So we're not out of the woods yet, but at least there is something in place where we've de-escalated those tensions. And Scott Bessent did say that he's going to be meeting with China again in the next couple of weeks to continue working on these agreements or a broader agreement where I think it could be good for American companies as well, is what they're hinting at. We'll see what that looks like. But just in general, from the investor's perspective and why the market is reacting the way it has been is because we no longer have the 145. And maybe this really is the art of the deal that we all know Trump for, and not these long-standing tariffs that can have more meaningful impact. Because when you think of how long it takes to build up a manufacturing plant, it takes 2 to 3 years to do that.
Yeah.
So if we're not going to be at 145%, and maybe we do just keep a 10% base rate just to continue getting some of these tariff revenues in the door, companies can then still pay those tariffs without having a significant or meaningful impact to their earnings or impact to the consumer. But then they can also start to allocate capital here in the U.S. to begin to build these plants out. It's much more stressful when you've got the higher tariff rates and you're trying to allocate capital, because if prices skyrocket, consumers are going to be buying less, which means you probably have less revenue, and you're trying to allocate capital to build something here in the U.S. It's a nightmare for companies to do that.
Yeah, it's a nightmare scenario.
Yes, exactly. So I think that's why we're seeing the reaction in the markets we are right now.
Sure. Yeah, they're way up. Right after the news, they went way up. So we'll see what happens. Every day is a new day. That's for sure in the market this year. But there are some positive signs. I think that's great. Now, we need to take another quick break. Jason, are you okay with giving away a few more copies of that book?
Yeah, that'd be a great idea, Tony. Thank you.
Yeah, the book is Empower Your Retirement. It's a book Jason wrote it has a lot of information in there that can help you with your finances. I encourage you to get a copy. All you have to do is be one of the next 10 people to request a copy, say you heard about it on the show, and that phone number is 989-835-7203. Again, it's 989-835-7203. Or you can fill out a contact form at GreatLakesInvestmentAdvisors.com. And we're talking with Tyler Ellegard, portfolio manager at Gradient Investments. We'll be right back with more of your Financial Empower Hour. All right. So Tyler Ellegard, Gradient Investments, portfolio manager. You talked about how the deal with China and some of the tariff deals have helped the market out. We first heard about a deal with UK. The market did take a bump because of that, but most consumers are like, wait, what do I buy that's made in the UK? Not much. When's the last time anyone out there picked up something and it said made in the UK or made in England on it?
Yeah.
Not too frequently, but China, Canada, Mexico, these are our main trading partners. And so a deal with China, that's huge. Jason, what else do we want to hear from Tyler on today?
Yeah, I think it's awesome, Tyler. Appreciate you sharing all this insight with us. I always call it, from in the trenches, right? So here I sit with all the families and clients that I serve, but I don't do the in the trenches stuff where I'm doing 100% of all the research of where to be, where not to be, what's going on, why is it going on, what's the forecast, and then actually buying and selling holdings and companies and sectors and regions and all that stuff based on how, what's going on in the market and the economy. That stuff happens in the trenches, and that's what Tyler and his team does at Gradient Investments. So to have you guys on the show to share that with not only with myself and Tony, but for all my listeners out there, I think it's awesome. Again, Tyler, so thank you for your time and insight that you give to us. Talking about tariffs is I think a big piece of the puzzle right now, but I want to shift gears. I'm just looking right now out at MSN Money as of recording this show year to date. So January through now, the market, the S&P 500 is up 11.2%. That's pretty darn positive, I think. I'm sorry, in the last 1 year, I stand corrected. In the last 12 months. So from last May till this May, the S&P 500 is up 11.2%. Year to date, we're down 1.2%. So Tyler, I want you to talk to me and my listeners about what does it mean in the short term. And if we go like to maybe sometime around April 8th, where we hit the lowest point of the year, I think the market was down quite severely in double digits. But here we are year to date, market's at 1.2% down. And over the last 12 months, we're still up over 11%. What's the big picture, and what are some of the other things other than tariffs? What are some of the other things, I guess, good and bad, that are currently impacting our markets and our economy?
Yeah, I mean, if I asked most people what they thought the markets were down in April, most people have said, the people that I've actually asked that, most people have said 5 to 10%. Mm-hmm. The S&P 500 was actually only down about 0.7% in April. It felt like a lot more. The news made it feel like a lot more, but we had a severe correction after April 2nd. Market bounced back, and then it slowly grinded higher. So, I mean, April really wasn't as bad of a month as most people think. And you're absolutely right. After today, with today's current reaction to the negotiation and agreement deals with China, the market is only down about 1% this year so far. And obviously it feels like a lot worse just because of what's all been going on. So obviously the tariffs and the news from Trump, that was self-inflicted. So he's kind of unself-inflicting it a little bit with these deals. Mm-hmm. So what we try to do at Gradient Investments is obviously we have to pay attention to the economic and news landscape, right? We need to pay attention to tariffs. We need to pay attention to inflation, economic growth, retail sales, all these different unemployment, all these different data points on the economy and also news. But what we try to focus more on is fundamentals of companies, meaning how healthy are the companies? Do they have revenue growth? Are their earnings growing? Are their earnings growing faster than their revenue, meaning their margins are getting better, costs are coming down? Mm-hmm. Do they have cash flow, right? Are they bringing in more cash than they are sending out, right? That tends to be a healthy company if they can generate more cash in their business than they're sending out because they don't need to take on debt, right? How healthy is their balance sheet? Do they have too much debt? What does that look like? What's the maturity schedule look like? All these different data points of the fundamentals of the companies. And that's what we try to focus on. And a lot of the other stuff can be noise at times, because when you think about a lot of the economic data that we get, it's always backward looking, right? We're trying to look at forecasts. We're looking at the current snapshot of the company and forecasting forward what we think their earnings growth is going to be, right? So we try not to get caught up in too much noise. We want to make sure that we're paying attention more to the companies. And one of the very important, what I call seasons, we just got through. We call it earnings season. Mm-hmm. So earnings season is when a lot of the S&P 500 companies report first quarter, second quarter, third quarter, fourth quarter earnings, and they do it 4 times a year, obviously. And so we just got through the period where S&P 500 companies have reported their first quarter earnings, which gives us a glimpse into how the previous quarter was. But what's more important, what investors tend to look at more, is what is the guidance or commentary the management teams are giving us about the future of the company. Some companies give you guidance on the next quarter, and some companies give you guidance on the rest of the year. It gives you a sense of how is the company operating going forward, and it helps us in our forecast to determine, is the stock price fair? Mm-hmm. Is it undervalued? Is it overvalued? So we just got through that earnings season, and coming into it, I think there was a lot of concern because there was so much uncertainties with the tariffs.
Mm-hmm.
Are we going to have tariffs, or is it going to be 10%? Are we going back to the larger tariffs of the reciprocal initial tariffs, whatever those were on each country? How much of that right? There's just so many uncertainties that were tied to tariffs. And so coming into earnings season, what our concern was that companies were going to take away that guidance from us, because even they don't know, right? Because they don't know if we're going to have 10%.
Sure.
They don't know if we're going to have 145 on China for the foreseeable future. So we were a little bit worried about them pulling that guidance away, because what tends to happen, we saw it in COVID, is when companies pull that away, you don't have the clarity. And so you don't know what the numbers are going to look like. And so you start to pull back on how much risk you're taking, because you just don't know. What was great for this earnings season was, yes, we saw a few companies pull that guidance on what the next quarter or the final year is going to be.
Mm-hmm.
But we actually saw a lot of companies either maintain what they had previously given us in past quarters, or they actually even raised their guidance estimates. So let's say a company was going to produce $1 billion in revenue for the next quarter. There's a lot of companies that actually raised that to say, maybe we'll generate 1.2 billion. Or for the rest of the year, maybe instead of generating 5 billion this year, like we initially expected, we're actually going to get 5.3 billion. Right? So it was actually a really good earnings season. Not only did they keep their guidance, but a lot of companies actually raised their guidance.
Yeah, which is, I mean, to me, sounds like almost contrarian. Like everybody would think, common sense would have told me, wait a minute, these tariffs are going to be a bad thing. If prices go up by 50%, 100%, oh my gosh, we're going to destroy relations with all these countries. I would think that a lot of these earnings would have been negative, right? I would think the consumer is going to shut down. They're not going to spend as much. Corporations are going to have lower earnings. And then they're even going to adjust their expectations for the next 3 to 6 to 12 months as a reflection of that to be less earnings. But what you just said, Tyler, is the reality that comes from most of these companies out of the S&P 500. The reality of this earnings season was most of them were very positive, and maybe even more positive than they anticipated, even after all this tariff stuff. And a lot of the forecast and outlook for the next 6 to 12 months is as positive, if not even more positive. So really, could tariffs potentially be a bad thing? Yes. And short term, I think they kind of were for a little bit there, but it really looks like overall big picture, everything's okay. I mean, we're really doing well in a lot of these corporations and companies, and they're strong, maybe even stronger, and projecting for strength moving forward. So from a consumer standpoint, I think that's a very positive thing, Tyler.
Yeah, absolutely. I mean, there are some companies, a good example is Apple. They came out and said for this next quarter, they expect $900 million in added cost because of tariffs, right? But what they also said was that they were gonna pull some levers to try to offset as much of that as they can, right? So you have companies that we have to remember that a lot of the companies that we look at and invest in, they're multinational companies.
Mm-hmm. Sure.
They are very sophisticated. They have a number of different levers that they can pull to offset costs if they need to, right? And that's what we're starting to see these companies do. Yes, maybe it's uncomfortable for the companies at times, and maybe it makes things a little bit tighter and could detract from maybe not this year's growth, but maybe it detracts from next year's growth or even further out because they're pulling back on some R&D things or whatever it is they're doing. But generally speaking, for this year, we came into the year expecting the S&P 500 to deliver 15% earnings growth. We always felt that was a little bit too high, and we were expecting more on the 9 to 11% earnings growth. The longer term average since 1990, the S&P 500, the average has been about 8% in earnings growth. So our projection, obviously we didn't, as we entered the year, we didn't know we were going to have the tariffs, but our projection hasn't changed. And the market, even outside of our walls, if you consider every investor collective that's doing this, the earnings expectation is down from 15% to 10.5% right now, which is still above long-term averages.
Yeah, still a very positive growth.
Despite all of this that's going on, companies are still healthy. They're dynamic. The management teams know what they're doing to deliver on what they've projected or expected themselves to do. And so I see this as a great season. The other aspect of it, and I could talk about this forever, is we've had the Magnificent Seven leading the stock market, right, for the last, call it 2 years. This year's been a little bit different, right? They've been the lag seven, as people have been calling them.
Or the pretty good 10.
Yeah, exactly. But they delivered great quarters, which is very important for the market, because if they make up 35-40% of the overall S&P 500 and they have a bad quarter or a bad report, that's going to be a detriment or headwind to the market going forward.
That's be a bigger negative impact on the overall market for sure.
Oh, yeah, I mean, Microsoft reported their stock was up 9% the day they reported. Meta or Facebook was up 6.5% the day they reported. So it was overwhelmingly cautious going into the quarter for these companies, and coming out of it, investors were all excited, right? AI is working. They're putting even more money into AI.
Yeah.
So that was a really important aspect for the market. But beyond that, we also had good reports in other areas of the market that have been what I would call poor as of late, whether it's some industrials, whether it's some healthcare. So we've had other areas of the market that haven't been doing well turn around in a time of uncertainty, which is always interesting.
Yeah,
but in a time of uncertainty, they've turned it around, and now it's things are looking pretty good. So I would say overall, what we're looking at for gradient investments, like I said, we have to pay attention to the broader picture. But when it comes to investing and picking the companies, we're paying attention to the fundamentals. We're paying attention to earnings season, and it was a lot better than we actually expected.
Yeah, and I think that's great. Now, unfortunately, we have to take one last quick break, and then we'll be right back to wrap up and get a few final thoughts. Listeners, if you have questions for Jason or Tyler, give us a call, 989-835-7203. And we're back with your Financial Empower Hour with our host, Jason Cryderman, and our special guests from Gradient Investments, portfolio manager Tyler Ellegard. Tyler, what do you think? Jason, what do you want to do to wrap up the show today?
Well, I think it's been an awesome show. I mean, we started off with, talking about remodeling Tyler's basement and my basement. We talked about Mother's Day, and we talked about Tyler's got a 1-year-old and a 3-year-old, and Tony, yours are all grown and gone in college, and mine are, I have an 11-year-old, a 14-year-old, and soon to be an 18-year-old graduated from college, going off to Michigan State. And then we went right off into this, the market and the economy and tariffs and how the market crashed, and then the market came back, and now really positive earnings season and positive growth rates from some of these companies that people maybe a month ago, if we asked these questions, who thinks we're going to have a positive earnings season, we probably would have got a lot of naysayers and a lot of negativity. Or who we asked the question a month ago, if we would have asked, how many companies do we think might increase their forecasts for the rest of the year versus decrease? And we'd probably have a heck of a lot of naysayers saying, oh, no, earnings season is going to be horrible for the first quarter because of these tariffs. Matter of fact, the forecast is going to be horrible. All these companies. And that's not the reality, Tyler. So again, I love hearing it from in the trenches, from portfolio managers who manage on a daily basis over $7 billion of assets for other clients around the country, including my clients. And so it's awesome to get kind of the reality behind the scenes, right? From the trenches. So thank you for sharing this insight with us. It's important for me when I meet with my clients and help them manage their portfolios. It's really important for those other listeners and viewers out there too, whether you're a client that I serve or not. So please take this information you're hearing and employ it into your own portfolios, or even take it back to your current advisors and say, hey, I heard some of this out there. How can this impact me and what can we do? One of the things I kind of just sitting here listening, Tyler, to you talk about in the last segment was you guys look to fundamentals. You guys look to earnings. You also mentioned kind of the philosophy behind it, but you didn't say the word diversification. As you talk about, you guys don't go to one sector one country, run one region, one company. You believe in diversify. And that's exactly how we build portfolios too, is diversify, right? We got to have a proper allocation and a proper diversification. And then the proper companies, countries, regions, or exposure within that diversification. So that's huge, Tyler. I appreciate this coming from you. One thing we didn't touch on, I'd like you to touch on if we have a few minutes here, and then maybe give us your 1 or 2 pointers or bullet points to leave my listeners today. But let's talk about the Feds. Let's talk about interest rates and what's happening right now versus what we thought might happen and where we think that might play out for the rest of the year.
Yeah. So the Federal Reserve last week, I guess as this airs, it'll be a week and a half ago. The Federal Reserve met and decided not to change their interest rates, despite the pressure that President Trump has been putting on them to lower interest rates. What I think is very challenging for the Federal Reserve right now. So they have 2 mandates. Number one is control inflation, control prices. The second is full employment, meaning they want to have as many people employed as they possibly can. And there's a few levers that they can pull, but the main one is raising and lowering their Fed funds rate, which is the base rate for any short-term debt security. And then you start to go out to the longer end, the 10-year treasury, 30-year treasury, the 30-year mortgage, right? So it's a baseline for where the rest of the rates are going to be. Mm-hmm. So the Federal Reserve didn't do anything. And what I think is very important for them, and why I think they're in a very challenging situation, not only because they have pressure from Trump, but because of those 2 mandates, when we're thinking about tariffs and the potential implications it can have on the economy. So if we think about tariffs and companies pushing the prices through, that's going to create inflation. And I don't think tariffs are going to be this one-time blip. You go from this price to this price, and then it just does that flat lines after that. Right. What I think is going to happen is, even if we do have these, like I said in the earlier segment, is the suppliers will take on 4% of the 10, companies will take on 4% of the 10, and consumers will take the initial 2 to 3%.
Sure.
But what's going to happen is companies tend to raise prices, call it 2% every year. Right. So instead of raising prices 2% every year, they might raise prices 3.5% every year, because they want to try and get back to the baseline that they were at prior to the tariffs.
Mm-hmm. Sure.
But then you also have the suppliers probably going to do the same exact thing, right? So they're going to pass on some pricing increases to the importer, the company that you're buying from, which means maybe that company does have to go 3.5-4% on pricing each year for the next 2 or 3 years to get back to the pre-tariff level of 10%, which means we're going to have a more persistent inflation rate, right? Instead of the 2% target, maybe that inflation rate stays persistent at 3%, 3.5%, which means the Fed needs to keep interest rates higher, because they want to try and control prices to try and bring them back down, or the growth of prices back in line to that 2% growth every year. Now, on the flip side, they have to keep full employment, right? So if we start to see consumers pull back because prices start to get too aggressive, because companies are trying to recoup some of the losses that they've had since the tariffs have been put in place, you're probably going to start to see some layoffs if consumer spending, because that's 70% of our economy, you're going to start to see some layoffs, which means unemployment rate goes up. And when that starts to happen, usually the Fed cuts interest rates, right, to try to spur growth. Sure. They want companies to take out loans to then do projects, do more research and development, whatever they need to do, but basically take out money, borrow money, go spend it, and hire people to do it.
Yep.
Right? That's a general sense. So you've got 2 conflicting things where they need to keep interest rates up if tariffs stay in place, and they might need to lower interest rates if there's unemployment rising. So they're kind of stuck in this challenging situation of, do they want to favor prices over employment, or do they want to favor employment over prices?
Yeah, it's a balancing act. I mean, it really is. And it could be a slippery slope either way they go.
Yeah, absolutely. So despite, I don't think they're gonna anything's going to happen with Trump and Jerome Powell. I mean, Jerome Powell's out here shortly anyways.
Mm-hmm.
So we're going to get a new FOMC president in 2026, I believe. So we'll see what happens with that, if it's going to be a yes man and maybe they do just end up cutting rates. But it's also it's a group effort, right? It's not just one person making that decision. So there's people on the board of directors for the FOMC, the Federal Open Market Committee, to make that decision. So even if Trump does appoint someone that will be a yes man or yes woman, it's still a group effort. They can't just push through a pricing cut because there needs to be a vote on it. So like I said, I just think the Federal Reserve it's a very tricky situation. I don't have a general sense of which way they're going to go. I think it's all going to be determined on what Trump and his administration do with tariffs, bringing that back full circle to the very beginning. So we'll see. We'll see what the Federal Reserve does. But as of right now, they're expected to do 3 rate cuts, which is 1/4 point each. So we'll see if they stick with that. I would guess they do 3 to 4 this year, just based on where interest rates are at, where inflation's at currently. But I've been wrong before. I'm sure I'll be wrong again. So
we all have, right? We're only human.
Oh yeah.
Keeps the industry interesting. But yeah, I think the Federal Reserve is in a very tricky situation, and I wouldn't necessarily expect your 30-year mortgage to come down very quickly.
No,
it's probably going to be around 6 to 7% for quite some time.
Yep. Well, Jason, we're out of time. Thank you so much, Tyler. We'll just leave that number once again for our listeners out there. We learned a lot today. If you have questions or want to get a plan in place, 989-835-7203. Again, that number, 989-835-7203. Thanks, guys.
Thanks, guys. Take care. Bye now.